Hi friends, welcome to the channel JIB and CIB Made Simple. So this is our risk management December 24, actually it is 24, December 24 memory based question. So this will help those candidates who are having risk management as their elective paper. So you can see which type of question are being asked in the examination, and you can prioritize your preparation. You can modify your preparation accordingly, right? So let's start with the first question that we have. What does buying an interest rate floor achieve for the buyer? Right. So in this particular slide we are going to see, I will not just explain the correct answer but also why the other options are incorrect using sample example to make everything crystal clear. Stay with me till the end for a quick summary of key points that will lock this concept in your mind. So question is, what does buying an interest rate floor achieve for the buyer? Option A says that it establishes an interest rate, maximum interest rate the buyer will pay. Option B says that it establishes a minimum interest rate that buyer will receive. Option C says that it limits losses in case of interest rate fluctuate. Option D says that it functions like a long call option on interest rate. So what do you think is correct? The correct answer is option number B, that is establish a minimum interest rate that buyer will receive. Why? Because you are buying an interest rate floor. What you are doing? You are buying an interest rate floor. It ensures that buyer receive a minimum interest rate. That you receive a minimum interest rate if market rate fall below a specified level. So suppose this is the level, and if market rate fall below it, right, if market rate here or somewhere else, right, so it means that if market rate fall below a specified level, that buyer receive a minimum interest rate. Think of it like an insurance. You can think of it like an insurance. You are protecting yourself from earning less if rate drops too much. For instance, if you invest in a bond and buy a floor at 3%, suppose you invest in a bond and buy a floor at 3%, even if market rate drop to 2%, you will still earn at least 3% on your investment. That is why option B is the correct answer. Let's see the option number A. Option A says that it establishes a maximum interest rate that buyer will pay. This is incorrect because it describes the purpose of interest rate cap. Try to understand, two things are there: interest rate cap, right, and here it is interest rate floor. So cap, if cap is there, then it means maximum interest rate. If floor is there, it means minimum interest rate. So cap set a maximum interest rate that buyer has to pay, which is opposite of what a floor does. For example, if you were borrowing money and wanted to ensure that your interest payment does not exceed a certain limit, you would go for a cap and not a floor. Option C says that it limits losses in case of interest rate fluctuation. While it is true that buying a floor can limit loss, this option is too vague and does not specifically explain the purpose of a floor. The primary goal of a floor is to secure a minimum interest rate, not just broadly limit losses. So this option does not hit the mark, right? And option D says that it functions like a long call option on interest rate. This is incorrect because a floor functions like a long put option. It functions like a long put option, not a call option. You know the difference between put option and call option, right? So you know what is a put option. A put option provide value when prices, or in this case interest rate, fall. So this put option provide value if interest rate fall, right? So on the other hand, benefits when price or interest rate rise, right? So call option, when call option it provide benefits, call option provide benefits when interest rate rises. So associating a floor with long call option is misunderstanding. So let us simplify with this real life example. Imagine you are running a lemonade stand. Suppose you are running a lemonade stand and you want to ensure that you always earn at least $1 per glass. You want to ensure that you always earn this $1 per glass, right? No matter how much the market price of lemonade drop, no matter how much the market price of this lemonade drop, you always earn $1 per glass. Buying a floor is like signing a deal where you are guaranteed to get $1 per glass even if the market price fall to $0.80. It's your safety net. So what are the key points which we have seen in this particular question? First key point is that buying this particular question, the main learning is that buying an interest rate floor guarantees a minimum interest rate for the buyer, right? It is similar to a long put option. It protects against falling interest rate. A cap establish a maximum interest rate that the buyer will pay. The purpose of floor is not just to limit loss, it is specifically ensure a minimum return. And also, that floors are not related to call option, they resemble put option, right? So remember, floor resemble put option, remember it. Okay, now let's move on to the next question. Question number 2, that is what we have. So question is, which of the following best describe a market in a contango, right? So option says that option A says that spot price is higher than the future price. Option B says that the future price is below the expected future spot price. Option C says future price is above expected future spot price and forward curve is upward sloping. And option D says there is no relationship between the future price and the spot price. Let's figure out. So friends, so let me tell you the correct answer. The correct answer is option number C. A market is in a contango occurs when the future price is higher than the expected future spot price, and this is reflected as upward facing forward curve. This happens because future price include extra costs. Like what kind of extra costs included in future price? Like a storage cost is there, like you say financing cost is there, right? Like you say insurance cost is there. So these are the extra costs which are included in the future price. Collectively, these are called cost of carry. Collectively, we call it cost of carry, right? Think of it like this. If you are buying wheat for delivery 6 months from now, the seller add storage cost to the price because they have to store the wheat until then. That is contango for you. Again, I am repeating. If you are buying wheat for delivery 6 months from now, you will not deliver now. Rather, you will deliver after 6 months. For that you are buying wheat. The seller add storage cost to the price because they have to store the wheat till then. That is contango for you. Option A says that the spot price is higher than the future price. This is wrong because it describes a backwardation. So it describe a backwardation market, right? Not a contango. In backwardation, the spot price is higher than the future price, often due to high demand for immediate delivery or a shortage of commodity. For example, if there is a sudden demand for oil right now, today price may shoot up compared to future price, creating a backwardation scenario. Option B says that the future price is below the expected future spot price. This is also incorrect because it confuses the relationship in a contango. You know, in a contango, the future price is higher than the expected spot price, not lower. A common mistake here is mixing up the expected future price with the actual future price. Remember, the higher future price reflects cost of holding the asset. Right. Option D says that there is no relationship between future price and the spot price. This is completely incorrect. There is always a relationship between the future price and a spot price, whether in a contango or a backwardation. Right. Future price are not random. They are influenced by factors like cost of carry, expectation about the future supply and demand, right, and market sentiment. Let me give you an example. Imagine you are at fruit market. Imagine you are at a fruit market, right, and you want to buy mangoes that will be delivered to you next summer. Right now mangoes are out of season and the seller quote a higher price for the next summer because they are adding a storage cost and other expenses for in today's price. And this is similar to a market in contango. Future price are higher than the expected spot price, right? So what are the key points which we have learned from this particular question? The first thing is that market in contango occurs when future price is higher than the expected future spot price, creating an upward sloping forward curve. Okay, this happened due to the cost of carry, which includes cost of storage, financing and insurance cost. Backwardation is the opposite of contango. So one side you have contango, another side you have backwardation. So backwardation is opposite of contango, where a spot price are higher than the future price. There is always a relationship between a spot and future price, whether in contango or in backwardation. Understanding this concept is crucial for derivative and commodity trading. I hope this explanation you find useful. Please hit the like button so that this video reaches to more and more risk management aspirant. Now let's move to the next question. Which of the following is a key feature of forward contract? Right, very good question. Option A says that it is traded on exchange and has a standardized term. Option B says that it is a derivative contract where the price and date are fixed and at the time of agreement. Option C says it involves daily settlement of profit and loss. Option D says it does not allow the customization of terms between parties. So the correct answer is option number B. Right, a forward contract is a derivative where two parties agree on a fixed price for an underlying asset and the settlement happen on a specific future date. Let me give you an example. For example, imagine that you agree today to buy 1 ton of wheat. You agree today to buy 1 ton of wheat as $500. Fine. With the delivery schedule 6 months from now. The delivery of it is scheduled 6 months from now. Fine. Okay, both the price and date are fixed at the time of agreement. At the time of agreement you freeze price also and date also. Okay, this makes forward contract predictable and useful for hedging against price fluctuation, right? Now option A says that it is traded on exchange and standardized term. This is incorrect because forward contract are not traded on exchange. They are OTC derivative. OTC, over the counter agreement, which means they are privately negotiated between two parties. On the other hand, future. On the other hand, if you have future contract, right, so future contract are traded on exchange and have a standardized term. For instance, if you want more flexibility in deciding terms like quantity, settlement date, you would choose a forward contract over a future contract. Now option C says that daily settlement of profit and loss. See, daily settlement is a future of this is a future of future, right, contract, not forward contract. Future contract are marked to market daily. Remember this, they are marked to market. When I say this word marked to market, what I mean to say that profit and loss are settled every day based on the market movement. Forward contract however settle at maturity. And using an example, think of forward contract as an handshake deal for delivery on a fixed future date. Whereas the future contract is like running a daily tab at cafe. Your account is adjusted every day. Option D says that it does not allow the customization of terms between parties. This is incorrect because forward contract allow full customization. The parties can negotiate terms like quantity, quality, price, settlement date of the underlying asset. For example, if you are buying sugar from a supplier, you can agree on the exact grade of the sugar, the delivery timeline, even the payment terms. You can also you can also decide, right? You can also agree. So this flexibility is what makes the forward contract unique as compared to the standardized feature. Let's bring this to life. Imagine you are a coffee shop owner and coffee price fluctuate a lot. To protect your business, you enter into a forward contract with a coffee supplier today to buy 100 kg of coffee beans, right? 100 kg of coffee beans at ₹10 per dollar per kg with delivery in 3 months. So no matter how the market price changes, you will pay $10 per kg on agreed rate. This give you price certainty and help you manage your cost better. So let's summarize the key point which we have learned in this particular question. Forward contract is an OTC derivative, that is over the counter derivative, where price and settlement date are fixed in advance. Second point is that it is not traded on exchange. They are not traded on exchange, making it different from future contract. Third point is that daily settlement apply to futures, not forward. Daily settlement it apply to future and not forward. Fourth point, forward contract are customizable. You can customize it, allowing parties to agree on specific terms like quantity, quality and delivery timeline. I hope this explanation help you. Now let's move on to the next question. Why are forward contract considered a zero sum game? Why are they considered a zero sum game? Let's try to understand. So option A says that both counterparty always make equal profit. Option B says that the total profit and loss across both counterparty always sums to zero. Option C says the contract is traded on exchange, ensuring no loss. Option D says forward contract are designed to eliminate risk for both parties. So correct answer is option number B. Forward contract are called zero sum game because one party's profit is exactly equal to the other party loss. When you add up the profit and loss of both sides, the total is zero. For instance, imagine two people. Person A agree to buy 100 kg of wheat. Person A agree to buy 100 kg of wheat at ₹20 per kg, right? And the person B after a month, from person B after a month, right? Now, if the price of wheat rise to 25 rupees per kg, suppose price rise to this much, so person A will gain how much? 5 rupees per kg. But person B loses the same 5 rupees per kg. Their combined profit and loss always balance out to zero, right? So that is what I'm telling you, that you can see option number B, that the total profit and loss across both counterparty always sum to zero. That is what I have explained. So this is the correct answer. Option A say both counterparty always make equal profit. What do you think? Obviously it is incorrect because forward contract do not guarantee equal profit for both party. One party gain is always the other party loss. So it is a balancing act, not a win-win. Think of it like a seesaw. When one side goes up, other side goes down, right? So this is about the forward contract. So this is wrong. This is correct. This contract is traded on exchange, ensuring no loss. Already I have told you that forward contract is an OTC derivative. They are not traded on exchange, right? It is made privately between two parties. Exchange traded contract like future offer protection like daily settlement, but forward contract rely on trust and private negotiation. Now, forward contract are designed to eliminate risk for both party. This is not true because forward contract don't eliminate risk. They merely shift them from one party to the other. For example, if you are a farmer, you might sell your crop in advance through a forward contract to avoid the risk of falling prices. right? So let's simplify this further. Imagine a cricket match where the bet is rupees 100. So suppose there is a cricket match and the bet is how much? Rupees 100. So if the team A wins, you gain rupees 100 and the other party loses 100. If team B wins, they gain rupees 100 and you lost rupees 100. The net gain and loss between both parties are always equal, 0. So forward contract work the same way. One person win is always the other person loss. Right. So let's summarize the key point that forward contract are a zero sum game because one party profit equal to other party loss. These contracts are over the counter agreement. Again I am telling you, these forward contract are like OTC agreement, not traded in exchange. They don't eliminate risk but redistribute it between the two counterparty. So the forward contract don't eliminate risk, rather it redistribute the risk between two parties, counterparties. The net profit and loss across both parties in a forward contract always sum to 0. I hope this explanation help you to understand the basic concept. Now let's move on to the next question. The next question, as you can see it here, just wait a minute. Yeah, I think this is the question, right? Okay. Zero sum game, we understand this question. Now let's see this. What is the capital charge for market risk in a foreign exchange and gold position and how it is applied? Right, very good question. So let us go through this particular question. So we are tackling a really important concept that often confuses many: how the capital charge for market risk in foreign exchange and gold open position is calculated and applied. Okay, we will explain an MCQ, break down all the options in simple terms and summarize the key point. So what is the capital charge for market risk in the foreign exchange and gold open position and how it is applied? Option A say it is 100% of the open position applied only to on balance sheet items, 9% of the higher of the limit or actual open position in addition to the credit risk charges, 9% of the open position applied only to off balance sheet item, 100% risk weighting for credit risk and no additional capital charge for market risk. So friends, our correct answer is option number B. That is, the capital charge for market risk in foreign exchange and gold open position is calculated at 9% of the higher of the two value, either the set limit or the actual open position. For example, let's say a bank has a limit of 10 crore. Let's say a bank has a limit of 10 crore for foreign exchange position, right? For forex, suppose a bank has a limit of 10 crore, but their actual open position is 12 crore. This 12 crore is the actual open position, right? So the capital charge will be calculated on the higher value. The capital charge will be calculated on 12 crore, right? The capital charge will be calculated on the higher value. This charge is added to the credit risk capital requirement for any related on balance sheet or off balance sheet item like loan or derivative contract. What is option A? Option A says that 100% of the open position. This is incorrect because the charge is not 100% of the open position. It's only 9%. Also the charge applied to on both on balance sheet and off balance sheet item, not just on balance sheet one, right? The option C say that 9% of the open position apply only to all. This is also wrong because capital charge applied to both on balance sheet as well as off balance sheet item, not just off balance sheet item like derivative. It consider all exposure that are subject to market risk. Option D says that 100% risk weighing for credit risk and no additional capital charge for market risk. So it is incorrect because it suggests that there is no additional capital charge for market risk. That is not true. There is clear 9% capital charge for market risk on the top of the capital charge for credit risk. So the bank has to account for both risk while calculating its total capital requirement, right? So let's put this in perspective with a simple analogy. Imagine you are a shopkeeper. You insure your shop for a fire damage and that is credit risk, right? But also need separate insurance for theft and that is your market risk. Similarly, bank must keep a separate buffer for market risk like fluctuation in foreign exchange or gold price, which is 9% of the higher of the limit or actual exposure, right? In addition to the credit risk charge. So what we have learned in this particular question, that the capital charge for market risk in foreign exchange and gold position is 9% of the higher of the limit or actual position. The charge is in addition to the credit risk charge for both on balance sheet and off balance sheet item. It applies to all exposure reflecting the probability of price movement, and the charge ensures that bank have enough capital to handle potential loss from market risk. Now let's move on to the next question. Very good question we are going to discuss now. Let's try to understand. Question is regarding that what is the minimum haircut applied to level 2A high quality liquid asset as per the Basel II standardized approach for credit risk. Before moving on to this question explanation, let me tell you friends, if you are preparing for risk management elective and if you want PDF in the format of unit wise theory, unit wise MCQ, previous year question PDF, right, which will help you revise all the things in a short span of time, you can opt for our PDF plan. For more detail, you can WhatsApp me on this particular number, or you can check the description section of this particular video. In the description section, I have provided a link to my app, that is AIB and CAIIB Made Simple, and using this app you can purchase the PDF plan, which will only cost rupees 200, and in this 200 you get unit wise theory, unit wise MCQ, as well as previous year question. No need to purchase any CAIIB Macmillan book, because each and every concept have been prepared from book only, and obviously it will be affordable for you, because if you purchase book it will cost you almost 500 rupees, and we are just providing the entire theory and MCQs PDF, unit wise theory and MCQ PDF for rupees 200. Additionally, we are also providing you previous year question, which will not be in your book. So obviously this is a win-win situation for you. So check the description box, check the link, click on the link, and you will get it through. Now let's move on to the next question. The question is in front of your screen, that what is the minimum haircut applied to level 2A HQLA as per the Basel II standardized approach. Let's see. So friends, option is a 10%, 15%, 20%, no haircut is applied. Correct answer is 15%, option number B. C, it means bank reduced the market value of level 2 HQLA by 15% when calculating the stock of the liquid asset. Why is this done? To ensure bank hold enough liquidity to survive a stress scenario. You know what is the meaning of this 15% haircut? A 15% haircut account for possible price fluctuation during a crisis, ensuring bank's liquidity remain reliable. For example, if a bank hold level 2A asset, you know level 2A asset, 2 is divided into 2 tier, level 2A and level 2B. So suppose a bank hold level 2A asset worth 100 crore. So they can only count rupees 85 crore toward their liquidity buffer. So this 85 crore will be counted toward liquidity buffer. Rest 15 crore, right, a haircut will be applied after applying 15 crore haircut, right. So option is say 10%. This is incorrect, because 10% is applied to a certain 2B asset, level 2B asset, which is lower quality asset. 2A asset require a 15% haircut. Option C say 20%. This is also wrong, because the haircut for level 2A asset is fixed at 15%. However, higher haircut may apply to riskier asset category like some corporate bond or equities under level 2B. Now, option D say no haircut. This is the common misconception and it is incorrect. Level 1 HQLA, you know level 1 HQLA? Level 1 HQLA like cash or government security typically do not require a haircut, but level 2A always have 15% haircut because they are slightly less liquid than level 1 asset. Think of haircut as a safety margin. You can think of this haircut, whenever you see this haircut, you can think of them as safety margin, right? Imagine you are buying a second hand car. You might negotiate the price down by 15% to account for future maintenance cost or risk. Similarly, bank apply a haircut to level 2A asset to ensure that they remain liquid and reliable during a financial stress. So what are the key points? First of all, we see what is haircut definition. Haircut reduces the market value of an asset to account for potential price drop during a crisis. Second thing, level 2A haircut. Level 2A haircut is 15%. 15% haircut is applied to level 2A because level 2A asset, which includes securities issued by sovereign, public sector entities or multilateral development banks. Now the question is why haircut? Why haircut is needed? To ensure that bank liquidity buffer is realistic and can handle a stress scenario. And other asset classes, level 1 asset typically have no haircut, and level 2B asset may have higher haircut, 20% haircut. Now hopefully this concept is clear now. Okay, now let's move on to the next question. You have heard the similar thing in your BFM examination, so no need to remember anything else. Now, what is the primary purpose of the liquidity coverage ratio in bank liquidity management? That is LCR. What is the primary purpose of LCR? Very good question. Very good question is it, right? So option A says that to promote long-term profitability by holding high-quality liquid asset. Option B says that to ensure sufficient high-quality liquid asset to meet liquidity need during a 30-day stress scenario. Option C say to eliminate the need for proportionality in maintaining liquid asset. Option D say to prioritize profit over liquidity in the stress scenario. What are the correct option? So friends, see. LCR is like a bank emergency fund. What is this LCR? You can think of them like a bank emergency fund, right? So correct answer is option number B, obviously, that the primary purpose of LCR is to ensure that bank hold HQLA to meet their liquidity need during a 30-day stress scenario. Imagine you are planning for a situation where you might lose your income for a month. You would set aside money to cover your essential expense during that time. Similarly, banks are required to keep assets like cash or easily sellable security to ensure they can handle the financial stress for 30 days without returning out of the fund. Right. Option A says that, so option number B is correct. Option A say to promote long-term profitability by holding high quality liquid asset. This is incorrect. Why? LCR is not about long-term profitability but also about short-term resilience. So here the keyword is resilience. It is about short-term resilience. Holding liquid asset may not generate profit, but ensure that bank has enough resources to survive tough time. Option B says, we know it very well, this is correct. Option C says to eliminate the need for proportionality in maintaining liquid asset. See, it is also wrong. LCR actually emphasizes the importance of proportionality, meaning bank must maintain a balanced ratio of liquid asset relative to their short-term liability. When I say it emphasizes the idea for proportionality, what I mean to say that meaning that bank must maintain a negotiated role of liquid enterprise related to their strong term liability. It ensures liquidity, not eliminate proportionality. Option D says to prioritize profit over liquidity in stress scenario. What do you think? So lastly, option D is incorrect because the LCR does the opposite. It prioritizes liquidity over profit, not profit over liquidity. In times of stress, the focus is on survival, not earning more money. For example, during a financial crisis, the bank would rather have enough cash to pay its obligation than worry about making a profit. Right. Think of the LCR as water tank you keep for emergency. The water represents your bank liquid asset. If the water pipe bursts in your house, that is a financial stress scenario, you can rely on the emergency tank to provide water for 30 days. Without this, you would be in trouble. So let's summarize the key point. The purpose of LCR is to ensure bank have enough HQLA to survive a 30-day stress scenario. Then HQLA example we have second, cash or asset that can be quickly converted to cash. That is why option number B is the correct answer. Now it is clear now. Now let's see this particular numerical question. Very good question it is. Let's see this question. A bank is calculating its capital requirement for operational is under the BIA. You know, basic indicator approach. The gross income for the last 3 years is given 100 crore first year, minus 50 crore negative, and third year is 150 crore. And now alpha is given 15%. So you have to calculate the capital requirement, KBIA, sometimes it is called capital requirement for operational risk. Sorry friends. So let's see the option that we have. So friends, what is the formula for basic indicator approach? You know the formula. What is the formula? So KBIA is equal to alpha times average of positive gross income for last 3 years. Right? So now here alpha is given how much? Alpha is 0.15, right? So now first step, let's solve it step by step. Identify gross income for the past 3 years. Let's see this. So you identify the gross income for the past 3 years, right? Year 1 100 crore minus 50 crore. So remember in the BIA you should know that if there is negative, if the gross income is negative, we have to ignore it, right? And year 3 150 crore we take into consideration. So you have to calculate the average of the positive gross income. What are the positive gross income? 100 crore and 150 crore and divided by 2. Neither in numerator nor in denominator we will take year 2 gross income. Remember it? So it will give us how much? 125 crore, isn't it? This is the second step. We have to take the average of positive gross income. And now you have to apply the formula, which is this formula. KBIA is equal to 0.15 multiplied by 125. So this will give us how much? So this will be how much? 0.15 multiplied by 125. This will be 37.5 crore. Calculate it, you will get 37.5 crore. Right? Capital requirement 37.5 crore. Let's see the option that we have. What are the options? First option says 30 crore. Galat, wrong. Because the calculation would require the average to be 100 crore. It is a common mistake if you fail to average the positive income correctly. 37.5 is correct. Option C is 15 crore. This is wrong because it suggests only a partial application of the formula. 45 crore is also wrong. So let's relate this to something simple. Imagine you are calculating your monthly saving. If you earned rupees 1000 one month, rupees lost 5000 another month, and then earned 15,000 in third month, you would not include the month with the loss while calculating your average saving. Similarly, in the BIA, only positive income are considered. So what are the key point? First key point is that BIA, alpha is equal to 15% and average the positive gross annual income of last 3 years. We have to exclude the negative income. If any year gross income is negative, it is ignored in the calculation. And that is how you calculate the capital requirement for operational risk using the basic indicator approach. I hope this explanation made the concept clear to you. Which of the following is not a characteristic of the asset side source of liquidity for bank? There are asset side source, there are liability side source. Which is not characteristics for the asset side source? Let's see the option. The first option, as you can see, that cash flow from loan and investment portfolio are primary funding source. Option B, pledging asset provide lower cost and more reliable liquidity compared to unsecured borrowing. Option C, asset liquidation is used as contingency measure in adverse liquidity scenario. Option D, securitization involve reducing liability through borrowing from central bank. So this option D is the correct answer. This is the correct and this is not a characteristic, because securitization does not involve borrowing from central bank. Instead, it is a process where bank convert loan like mortgages or credit card receivable into securities that they sell to investor. So basically what bank do, loans are converted to securities and these securities are then sold to investors, right? Basically mortgage backed security that they convert, right? So this provide liquidity by freeing up bank's balance sheet, but it is not related to the borrowing or investment. So hopefully this concept is clear now. Why option D is correct? Now option A says that cash flow from loan and investment portfolio are primary funding source, right? Asset side source of the liquidity for the bank. This is correct because bank generate periodic cash flows such as principal repayment and interest income from their loan and investment portfolio. These cash flows are crucial for funding the bank operation and maintaining liquidity. Think of it this like a steady income you get from renting out a property. It is a reliable source of cash. Option B say pledging asset provide lower cost and more reliable liquidity compared to unsecured borrowing. This is also correct. When a bank pledges its asset like security to secure a loan, it gains access to cheaper and more stable funding compared to borrowing without collateral. For example, getting a loan by mortgaging your house is often more affordable than taking an unsecured personal loan. Option C says that asset liquidation is used as contingency measure in adverse liquidity scenario. This is correct point. In tough time, bank might sell off asset like loan or security to raise cash quickly. It is similar to selling your jewelry or stock during a financial crunch. Sorry friends. Option D says that securitization involves reducing liability through borrowing from central bank. This is incorrect. So imagine you have a collection of assets, say jewelry, stock and rental property. Your rental income, that is option A, is your steady financing source, isn't it? Then if you need a loan, you can use your asset as collateral for lower interest rate. Option B says the same. In emergency, you might sell your jewelry or stock for quick cash. Option C says the same. But borrowing from a bank based on these assets is not the same as securitization. That's like converting your rental property into share and selling them to investor to raise fund. Completely different from borrowing. So you should know that asset side liquidity refers to using a bank loan, securities and other asset to manage liquidity. Primary funding source means cash flow from loan and investment provide regular income. And securitization is a different concept. That's why option number D is the incorrect one and that is the correct answer here. Now let's see the next question. Next question is which of the following statement about MIS for monitoring liquidity risk is not correct? Which is not correct? This is asked for MIS. MIS, it is nothing but management information system. So option A says that the liquidity MIS should assess both a static and forward looking cash flow projection for both business as usual and contingent liquidity scenario. Option B says funding consideration report should focus on diverse source of fund rather than highlighting dependency on sensitive source. Option C says MIS should include the status of early warning signal and contingent funding source. Not correct, right? Liquidity MIS must report the impact of new product and investment activity on the bank liquidity profile. So option A, what is the correct answer? Correct answer is option B. Why? Because funding concentration report are actually designed to highlight the dependency of a bank on source of fund that might be vulnerable to liquidity risk. For example, if a bank rely heavily on single source of funding, suppose there is only a single source of funding, it's like large investor or particular type of deposit, it is risky. If that funding source dries up, the bank could face liquidity problem. So these reports focus on identifying risky dependency, not avoiding them. Sorry friends. Option A says that liquidity MIS should assess both static and forward looking cash flow projection. So this is correct because the purpose of liquidity MIS is to assess both current and future cash flow under normal and stressful situation. Think of it like as looking at your bank account today and predicting how much money you will need in the next month or two. Right, that is option A. Option B says that MIS, that is correct one. Option C says that MIS should include the status of early warning signal and contingent funding source. This is also correct. Early warning signal could be things like sudden drop in deposits or an increase in loan default, which could indicate future liquidity problem. A good MIS system will also track available funding sources like line of credit or emergency loan that the bank can use if needed. Right. So that is why option number C is correct. Option D says that liquidity MIS must report the impact of new product and investment activity on the bank liquidity profile. Correct. When a bank introduces a new product or investment, it is important to see how it will affect the bank liquidity. How quickly can they convert it into cash if needed? For example, if a bank has started offering long-term loan with lower interest rate, it could lock up their cash for a long. So the MIS need to track how this new activity impact liquidity. So let's take an example to make it more clear. Let's say you are managing your money, your personal finance. Right. So option A, you check your current account balance, static, and make budget for next month groceries and bill. Option B say you would avoid putting all your saving in one risky investment and ensure your funds are spread across all safe sources. Option C say you keep an eye on your spending habit like sudden shopping spree or missed bill, and you know where to borrow money if you need it. Option D say that you consider how buying that new car will affect your saving and whether you have enough cash for emergency. Right. So hopefully the concept is clear now. Now, which of the following statement best explain the relationship between duration, convexity, and yield change? So these questions we will cover in our paid channel. In the paid course, I will provide you video explanation of each and every question. If you want to be part of it, please WhatsApp me on this particular number. I will help you to provide the content. Right, we are working on providing video solution also for risk management topic. Soon it will be available on our app. I request you to please install our app. The link of app is provided in the description section. Name of our app is CAIIB and CAIIB Made Simple. Thank you.